everyone, welcome to my YouTube channel. My name is Jerry Chen, a chartered professional accountant located here in Oakville, Ontario, Canada. My mission is to become the Google map for hardworking Canadians seeking financial freedom. And today's topic is incorporation for realtors, what it is and what can it do for you, and how you can use it to lower your tax rate to as low as 12.2%. Every week, I send out an email about money saving tips and real estate tax tips, all designed to help you build your long-term wealth and live life on your terms. The email takes 5 minutes to read and over 10,000 Canadians get it. Think you'll like it. Sign up using the link below. Ontario real estate agents were not allowed to incorporate until October of 2020. And before that, you are stuck with reporting all your business income in your personal income tax return as a sole proprietorship or partnership. And what it means is that you could pay as much as 53.5% tax on your income. Now, if you don't understand how the Canadian personal income tax work, you can see on screen that that's your 2020 personal income tax rate. Essentially the way it works is that the Canadian personal income tax operates on a progressive tax system. The more money that you make, the more taxes that you will have to pay. Basically, between $13,000 and $45,000, that difference, you need to pay about 20% tax. Between $45,000 to $49,000, you will have to pay 24% tax. And then it keeps going up and going up and going up. And at the end, if you make over $220,000 after deducting all your expenses, if you net over $220,000, you have to pay 53.53% personal income tax on any amounts that you make over $220,000. Let's say there's a deal that you're closing. You could choose to close before the end of the year, or you could choose to close it after the end of the year. That additional deal of $10,000, you only get to keep 47%. Above and beyond, CRA is going to keep it. CRA gets to keep 53%, so which is more than what you get to keep, unfortunately. This is the reason why it gives such a benefit to people who are high income earners to set up a corporation. The corporation tax for active business income, for all the commission income that you earn, less than $500,000, all you need to pay is 12.2% income tax rate on it inside the corporation. 12.2% compared to 53.5% is substantial. And this active business income of less than $500,000 is available annually, every single year. It's not a cumulative amount. Every year, you get a fresh set of $500,000 that you can pay 12.2% tax. But then people often ask me, don't you have to pay personal income tax when you draw money out from your corporation? Well, the truth of that matter is that our tax system is designed in a way that if you were to set up a corporation and take out all the cash in the same year, your personal income tax would equal more or less the same as your corporation tax plus your personal income tax if you own the business in a corporation. Say if you own the business in your personal name and you report for $150,000 net income, you would have to pay $45,000 personal income tax, roughly. If you earn that same $150,000 in a corporation, on the other hand, the corporation pays the 12.2%. And then any leftover, you take it out and report the full amounts, take every single dime out from the corporation and report it in your personal income tax. The combined of the corporation tax and personal income tax between the two entities, the corporation and yourself, would equal more or less the same $45,000. So there is no tax benefit. What's the strategy? There is no tax benefit. Well, the strategy is that particular tax integration calculation is purely based on the fact that you are going to take out every single dime in the corporation. If you're not taking anything out, if you're not taking everything, you're leaving some amount in the corporation, that amount, you don't have to pay personal income tax. So that amount that you're leaving, the more that you're leaving in the corporation, the less personal tax that you would have to pay. And as you know, personal income tax could go as high as 53.5%. So the more you can keep in the corporation, the better it is, the more tax deferral that you would have. Now, what's the best strategy? The best strategy is to take out what you need, Keep maximum amount in the corporation. Let's use an example to explain. We have realtor Peter here. Peter, the realtor, earns $220,000 gross commission income on average per year. He incurs on average also about $70,000 business expense. So he reports the net amount, $220,000 minus $70,000, $150,000 net business income annually. He pays about roughly $45,000 of income tax plus $6,000 of CPP. Because you also, if you were not to set up a corporation, you would have to pay a both employer and employee portion of the CPP. Roughly work out to be about $6,000. The $45,000 plus the $6,000, which is about $99,000 of after-tax earning. So then we look at what Peter really needs that's non-deductible, unrelated to the business. So we look at Peter's budget. He needs about roughly $3,000 to pay for his home expense. He eats, his grocery bill is around $500. He also set aside $500 per month for traveling expenses. Gym membership every month is about $100. He spent another $100 on clothes on a monthly basis. And then there is all the other miscellaneous expense of $800. So he basically need about $5,000 for all these personal expenses that's unrelated to the business. So which means that $5,000 is equivalent to about $60,000 annually. He needs $60,000 annually after tax to pay for all his personal needs. Now, in that situation, if he didn't set up a corporation, he net about $150,000 pay the tax and CPP. He roughly has about $99,000 after tax earning. And then he pay personal expense of $60,000 that we just came up with. And so after these personal expense, he net about $39,000 for savings and for investment for retirement purpose. If Peter, the realtor, were to set up a corporation, what would happen? Let's look at that situation. Now, if Peter, the realtor, set up a corporation, earned that $150,000 net business income, and then the corporation pays the corporation tax of 12.2%, so that means the corporation would have to pay $18,300 corporation tax. The net profit after tax is about $132,000. Now, the dividend, because Peter, the realtor, also needs to take out money to support his own personal expenses of $60,000. He needs to pay himself enough to cover the personal income tax as well as his personal expenses. So he needs to take out about $67,000 in this case from the corporation to himself to pay for his personal tax as well as his personal expenses. So after paying himself, we take the net profit after the tax in the corporation, which is $132,000, take out enough to pay for his personal income tax as well as personal lifestyle expense. He still nets about $64,500 available in his personal name to invest. If he owned his business in his personal name, he only had $39,000. Whereas if he set up a corporation and only take out what he needs, he would net $64,000. So there is a delta of $25,000. That $25,000 essentially represents the amount that he would otherwise pay to CRA as his personal tax. So this is the strategy. You pay less tax, you pay 12.2% tax, draw minimum amount as salary or dividend. Then there is more money available to reinvest in the business. There's more money available to invest for retirement and save for rainy days. And then there is more money available in general for everything to allow you to make more money. When it comes down to whether you should set up a corporation or not, first thing is how much cash flow do you need to support your personal lifestyle? If you need every single dime from your business, there is no tax benefit to setting up a corporation. Number two, do you need the cash flow right now? If you have other source of income, you may actually not need the cash flow. For example, I have a few clients who already have a full-time job, but they become a part-time realtors. So they actually don't need the income from their realtor business to support their personal lifestyle. So that makes a huge difference. Do you have any retirement strategies? If you don't have any retirement strategies, having the corporation, reporting all your income and expenses, and use the corporation as a saving vehicle, it would help you substantially because you are saving taxes and you're using CRA to invest for your future self. And do you want to use CRA's money to work hard for you? Do you have someone that you can split income with? There is opportunity in the future for you to maybe potentially split income with your significant other or lower income family members. Now that we have gone in depth in terms of calculating or deciding whether you should set up a corporation for your real estate agent business or not, here are some of the most commonly asked questions that we've encountered by setting up quite a few corporations for real estate agents there. The first one is, can I use my existing corporation as personal real estate corp? In Ontario in particular, you are allowed to use your existing corporation as your prac. However, the governing body, RECO, Real Estate Council of Ontario, does require that the corporation can only have one type of equity owner, which has to be the licensed real estate agent only. So let's say you have a corporation set up years ago with your significant other who is not an agent. So you each has 50% of share. That probably would not be the right corporation structure for a personal real estate corporation. But on the other hand, if you have a corporation that you don't have anything in and you own it 100%, it is possible that you can use that corporation for setting up as your personal real estate corporation. Second question, can I have a holding company? At the very beginning, when real estate agents in Ontario were allowed to set up a corporation, it was not clear whether they were allowed to have a holding company. And subsequently, RECO came out and then clarified that real estate agents would allow to have a holding company owning your personal real estate corporation. The only catch is that because the requirement provided by RECO is that you are required as a prac, a personal real estate corporation has to be 100% owned by the licensed real estate agent. So even if you put a holding company in between your prac as well as you would have to own that holding company 100% as well. So you can't have other people owning equity shares of the holding company. So that significantly reduces the benefit of income splitting by having a holding company structure. Can I use my prac to invest in real estate or stock market? The answer to that question is yes. You would be able to use your personal real estate corporation to invest in real estate and stock market. Now the challenge is that sometimes the bank may not lend money to a corporation that is also earning active business income. They don't want to give a mortgage to a corporation on a residential property that's also earning active business income. They don't like it. It's not a rule per se, it's more of an experience talk that I've gone through those hoops that I got turned down last minute because that corporation that I am trying to qualify for mortgage for has a small amount of active business income. They don't like it. They said, okay, no, I'm not going to lend it to this company because it has active business income. You could use your fund in that accumulated earnings in your personal real estate corporation to also invest in the stock market. There is no restriction, as far as I understand, to invest in the stock market. You may not want to use your prac to do all these investment at all. The only reason is because you would have a different set of risk profile within your business. If you ever get sued by any of the deals that you perform, not that I'm saying that you would, but who knows, if that unfortunate event ever happened and you get sued by something and you're held liable and you have all your cash sitting there, all your investments sitting inside the same corporation, essentially your investment and life savings are also being exposed to your business risk. So you may not want to put them in the same corporation as a result. But again, as long as you're comfortable with the risk that you're exposing to, you can choose to own your real estate as well as stock investment inside a corporation. And that basically gives us a high-level conclusion in terms of how you can determine whether a real estate agent should set up a corporation or not. And I've also answered a few commonly asked questions on Realtors Incorporation as well. If you like this video, make sure that you give us a thumbs up and hit the subscription button below and turn on the little notification next to it. And if you find it useful or could be useful to your friends and families and colleagues, make sure that you share this video. And if you have any questions about real estate corporation, personal real estate corporation, leave it in the comment section below and we'll get back to you. Thank you for watching.